But we're coming into a period that I could think looks a lot like Japan from the 80s, where it topped out, and we may not see new all-time highs in the stock market for literally 20 plus years. And for a lot of people that are banking on the rise in these assets, stocks, to give them retirement money, that could really be what hurts the consumer and keeps us in this longer-term bear market.
There's a lot of volatility to start the week. It's Monday, the 23rd of February, and stocks are down. Bitcoin's down. The S&P 500 is down about 1.5%, and so is the NASDAQ. Bitcoin is down about 4.5%, down towards $64,000. Gold's catching a bid, up 3% to $5,200. We're going to find out what's next with Bitcoin, gold, stocks, and treasury yields, and much more with our next guest, Gareth Soloway, president of Verified Investing. Over the weekend, Trump announced new tariffs, and it looks like the possible strike against Iran is now looming, and the region's heating up. So we'll find out what's next for the entire market. This video is sponsored by Kalshi. It's a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. New users will get $10 deposited to your account when you trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Gareth, fan favorite, welcome back. Good to see you.
Hey, thank you, David. It's so good to be back, and there's a lot to discuss today.
Yeah, Trump over the weekend raised tariffs again, and this comes after the Supreme Court ruled against his tariffs, and I guess in an act of defiance, he added 10% more and then raised it to 15% on Saturday. And now we have what is looking like an imminent strike on Iran based on the forced posturing of the military buildup in the Middle East. And I don't think markets are taking either of these things quite well. We've got a big slide in the stock market, like I talked about in the beginning of the introduction, and also Bitcoin down 4% on the day. So we're going to start with stocks and then move on to Bitcoin first. What is going on with the stock market right now? Perhaps this is a sell the news, buy the rumor kind of event where it's panicking today, but perhaps tomorrow or later on in the week, we could have buying opportunities. Or do you see this as kind of the continuation of a bigger downtrend? And by the way, I just want to point out that you've been bearish on the stock market for quite some time, or at least cautious. And actually, if you look at most of the Mag 7 stocks, they've had a terrible start to the year. And I was just reading an article from Yahoo Finance. Stocks are off to their worst start compared to just, year to date since 1995. Mm-hmm. I mean, even though if you look at the NASDAQ with the headline S&P 500, we're not getting a huge slide off, but or downtrend since the beginning of the year. But so far, compared to previous starts of the year, it's been pretty bad. So let me just let you digest what's been happening so far year to date and what's importantly happening this week.
Yeah, so let's start off with the tariffs. I want to explain why the markets on Friday bounced and then are selling so sharply today. So number one, you're right. For the last few months, I've been bearish on the stock market, mainly because the charts have been telling me that there is downside. There's major distribution amongst institutional money. We've kind of gone sideways in the stock market within a 5% range, chopping, but that's a classic sign of institutional selling, as we know retail continues to lever up. And so that, again, is creating a sideways choppy market. Now, number one, on tariffs. So the Supreme Court said that his pick and choose, you get 50%, you get 30%, that's illegal. Congress has to do that. But what he can do, and what he did do, is do a blanket. If he does a blanket tariff, there's a way he can do that. And you're right, he went from 10% to 15% over the weekend, even raising it more. And that's what the markets are unnerved about. So on Friday, we rallied after hotter than expected inflation because the tariffs were struck down. So the market said to themselves, okay, well, we have hotter inflation, but if you get rid of the tariffs, it should bring inflation down. Over the weekend, him putting it at 15% ratchets it right back up and makes that inflation data now meaningful again from Friday's PCE data. In addition, it's more uncertainty because we had done trade deals as the U.S. with various trading partners where the tariffs were less than 15%. But because he has to blanket it, now all of a sudden he's got 15% on players that were only at 5 or 10 or 12%. And so this uncertainty is just unnerving the markets. Now, if we take a look at the charts here, Let's go into that because that's where really everything shows itself. So, number one, here's the S&P 500 chart. And we can see a classic down day today, down about 1%. Now, if we zoom out, this is why I've been bearish on the markets. Everything I do is all based on probability, which comes from the charts. We can see parallel channel, the lows all connecting from COVID to the bear market lows of 2022 to the bear market liberation low or the drop from those tariffs a year ago in April. We dragged that parallel right up to the bull market, and look at this. We tagged the line right here. Since then, all we've done is chop. Upside is limited. You can only go back up to there without hitting the brick wall of this parallel. The downside is the most likely culprit. In addition, we have a trend line from the April lows that we were hammering on. Look at this, because this is really where the downside, and I got even more bearish about a month ago. We have this big bounce from the liberation move all the way to this low in November. We bounced again, hit the line, hit the line. Look at how it's like a ball bouncing smaller and smaller till we broke, retraced, and now my guess is we're heading much, much lower on the S&P. And again, I'm looking at a downside move by mid-year back to about 6,100 on the S&P. That would be your first major technical support.
6,100. Let me just pull up my calculator. That's versus current levels. We're looking at about a 10% decline. I mean, not the end of the world, but we're not looking at super bullish patterns, is what you're saying.
Yeah, and I think what's important to note is that I don't think that after we hit that level, it's not like we're going back to all-time highs. That's a stepping stone with lower lows and lower highs in it. So after we tag that line, we probably do get a bounce. So here's the down move into that level right through here. We get a small bounce here to the upside because you'll get buy the dippers to come in. And then I think we go even lower and we should end up attacking the low end of the parallel. And as we can see, that's really what happened, right? In the bull market highs, we went from the bull market of 2021 to the low of bear market and right at the low end of the parallel. My guess is even though we'll have plenty of bounces, eventually we do find our way all the way down to 5,600 or so on the S&P.
Are markets, any of the markets, signaling war right now? If you look at any of the charts.
Yeah, I mean, you could argue that at least oil, right? Crude oil is certainly has rallied. And this is a chart that, remember, coming into year end, you asked me for my top plays of 2026. And I said my favorite one was oil. And that was when we were down here. Look, I mean, this was the December 15th, 16th low down here at $55. Here we are at 66 on the charts. This one's certainly pricing in something going on, but I also think it's a money rotation, right? We came into the year with silver spiking. We came into the year with so many assets at highs. Nothing was at its lows except oil. Natural gas has gotten there over time, but I do think there's partially a reversion trade. And one thing this is amazing, folks. So the shale boom is coming to an end. The shale boom is what made the U.S. independent from all the other countries, a massive producer. But shale, if you look it up, it produces for about 2 years, and then after that, it goes down to about 20% production. We're right at the tail end of the shale boom, so I still think we have another year or two, but be careful, folks. We could be in a year or two, even if the economy slides into recession, oil could be $100 per barrel. That would not shock me one bit.
Are you bullish oil right now?
I am still bullish. I did take some profits off on my personal trade because I was up about 17% since I got in at those lows, but I still think there could be upside, and especially with what's going on with Iran, I think you shade that. Maybe if nothing goes on, it pulls back. I still think overall on pullbacks, we buy oil as long as it does not take out this technical level at $55 a barrel. That's your base plate. So as long as you stay above, I buy pullbacks.
What happens once we have a strike on Iran?
Well, I think you see an initial rally to the upside, probably a 5 to 7% move. Now, back 10 years ago, it'd probably be a 15 to 20% move, but obviously the U.S. is still producing a lot of oil. We're not as dependent on the rest of the region. Assuming it doesn't spread and it's very localized and short, and I do believe, by the way, that the president is very aware coming into the midterms that he does not want to create a massive spike in oil. So I don't think it's going to be a long-lived move. I think, if anything, it's a very specific strike to get a point across. But ultimately, I think, again, short-lived pop, then it comes back in and eventually grinds higher from there.
Okay. What happens to risk assets, though? On the one hand, we can argue that perhaps there's a localized conflict that doesn't impact the rest of the world, but on the other hand, it may signal more volatility and uncertainty, which markets don't like. So are you betting on lower prices from Bitcoin and stocks if we do get a hot war?
Yeah, so I think the stock market is going to continue to be under pressure. In the near term, I'm unbelievably bullish on Bitcoin here. Again, one of the things that I think is so interesting is that you have this pattern on Bitcoin from its flush out here, where we actually have an inside bar bullish pattern. Now we are breaking this level at 66,000, which weakens the pattern a little bit, but as long as we stay above 60,000, this is a very bullish pattern. The other thing is that the sentiment in crypto is so unbelievably bearish to the point where the fear and greed is like at 4 or 5 and it's been in below 10 for the last month or so, is that to me is a contrarian indicator. And so when you match that up to the charts here, you look at a scenario where we could be seeing a big relief rally all the way up to 80 to 85,000. Now, I don't think Bitcoin's going back to all-time highs anytime soon. I believe this is a bear market rally. But as a swing trader, I'm moving into Bitcoin and some altcoins down in this range for that relief rally. And I'll tell you what the trigger is going to be, in my opinion. I think in the next month, we are going to get a deal on the bill that has basically been stalled out in the government on crypto, where the banks were pushing for something. And I think once there's an agreement there, you get a big relief rally in Bitcoin and the altcoins, where you could see about 20% upside in Bitcoin and as much as 40 to 50% upside in altcoins.
What changed your mind? I believe, were you looking at, I think you were looking at lower levels for Bitcoin, were my mistake. And I think last time I had you on the show, you were looking at levels that once Bitcoin gets, retraces to, you would be going all in. We're not all in, but you would be going in along the position. Have we touched those levels right now? Is that what happened?
Yeah, that's precisely what happened, right? So again, if we look at this chart on Bitcoin here, look at this. This was kind of that former level. We talked about it, I think, the last time I was on, talking about the 2021 bull market highs right here. We dragged that line across, and even as high as maybe this consolidation right here. And if we zoom in and see where Bitcoin is trading, look, it's right in that range. And so I do want to be clear, though, David, is that, I actually still think Bitcoin is going to eventually go lower. I'm just anticipating a relief rally based on sentiment being far too bearish. And by the way, one thing of interest, if you match up the chart on Oracle and Bitcoin and altcoins, it's almost identical, and the software stocks, which makes a lot of sense because a lot of the altcoins are kind of softwares, right? And so I do think we're getting due for a software rally. Oftentimes you'll ask me, like, where do I put money in the market right now? I think you're due for a relief rally in the software stocks, and I'm expecting Bitcoin to rally here and then eventually go even lower, probably sub 50,000 down the line. But I think there's a good opportunity, at least for me. Listen, and I've been wrong before, as many people know, and I could be wrong again, but probability-wise, the odds are starting to shade a big bounce in crypto here.
And that's the key. You're not, permanently bearish or permanently bullish. You're looking at trends, and right now the trends are looking at a short-term bounce upward.
Short-term bounce upside to maybe 80, 85,000 on Bitcoin, which would net us let's do a measurement here on that. That would give us anywhere between 24 to about 32% upside in Bitcoin. And then I think after that, this would be just an intra-bear market rally where we see eventually a move to the downside from there. And I still think we're probably going sub 50 before all is said and done on
So
the
how are you playing that then? If let's say you've got an intra-bear market rally, are you just going to wait that out and see, basically short it or be on the sidelines until it goes lower? Or are you actually trying to capture these shorter term moves right now?
So I'm definitely moving into longs in my crypto portfolio here. Again, I'm very diversified I have my stock portfolio, my crypto, my commodities. So I'm very well diversified in that way, as we never know what can really happen, as good investors know. But I am, yes, long, short term. Short term here, I am long crypto. If we get a bounce up here, I would consider shorting it at that point. But for now, I'm long, net long. And again, we'll watch and see. And the beautiful thing, like you said, is that all I'm doing is analyzing charts and pattern, price, and time factors. And that gives me a probability number. And if it's up to a certain level, like 70, 75%, then I say, okay, well, if I'm going to win 70, 75% of the time this occurs, I'm going to go long every time, knowing that 3 times out of 10, I'll be wrong. But as long as I'm right 7 times out of 10, that's how the probability plays out. Essentially, I become the casino versus the gambler. And that's really the long game here.
I want to just focus on some macro for now, and then we get back to the charts here. So this is from Kalshi. It's a prediction market. Inflation in February, traders are predicting 2.3%. Above 2.3% is the most likely outcome. So basically no lower than the current level of 2.4%. Inflation is only going to go up is basically what this particular market is telling us. What is your view on inflation? Because that ultimately affects how the Fed is going to react, and that could impact markets.
Yeah, so I'm in agreement. In fact, the CPI that we got a couple of weeks ago, I did not buy that one bit. The main factor, number one, is it was an incomplete data due to the government shutdown in January that was brief, but it didn't. Apparently, there were some points missing there. But also the fact that CPI is made up of 30% housing and rent, and that's been falling. So that's been bringing the net number down. But when you get the broader context of the PCE, which is a much broader gauge of inflation, we saw it actually moving up recently. That's the number that most of us out there are feeling when we go to the store, when we buy groceries, etc. So I do think that's the key. And as long as the commodities like copper stay near all-time highs and silver does as well, and oil's been creeping up, then you have to favor an uptick in inflation in the coming weeks and months. Now, again, if we start to see a bigger worry about macro, the economic side of the US, then eventually those commodities come in and inflation can start to come in as well. One thing I want to show you that's super interesting on the chart here is that we have seen a fundamental shift in yields now, how it pertains to the stock market. So if you remember, David, it used to be 6 months ago, 3 months ago, if yields went down, what did the stock market do? It went up. Right? People were like, yay, lower rates. This is great. Free money or cheap money. We've now started to see, and you can see on this chart, look at today's down day. The yield is down to near to 4%, 4% on the 10-year, and stocks are down. If you go to Friday, markets rallied, yields were up. If you go back to these previous days, yields go up, market goes up. Now, the reason for this is fascinating, is that we went from saying, okay, the economy is sturdy, and the Fed is going to lower rates to the normal level, the 2%-ish, whatever their baseline was, where they think is the Fed funds number. That was what the market was all about. So it was like, okay, well, yay, we're going to get lower rates, but the economy is going to be strong. Now we're at a point where the markets are saying, uh-oh, yields are going lower because the economy is weakening, and the Fed is now shading not cutting rates that much because of inflation. So now rates going down is bad because it's economic based. It's fascinating.
And we're probably get an environment where lower yields will just signal basically a correction in the stock market, is what you're saying?
Yeah. It basically signals economic growth is slowing, potential recession, which means corporate profits are going to go down, and that therefore the stock market has to go down.
One piece of news I want to bring to your attention. So there might be a big refund by the order of up to $175 billion back to import companies because these tariffs were ruled as illegal. And so this might happen over the course of the year. Is that going to help stocks catch a bid, you think, if companies get basically a cash injection?
So I think so it's going to be interesting. I mean, this is such a mess because the question is, do you give it back to the import companies? But then they raised prices on a lot of the goods, so then all you and I paid it in terms of higher prices. So do we get a refund? And again, this is so messy. I have no idea how it's going to play out. But what wouldn't shock me is that a month or two before the midterm elections, if all of a sudden there's a refund check going out to most Americans, maybe Americans making under X amount, that could be an analysis point that could come through, and in which case that would help in the short-term consumer spending, which could help the stock market.
Okay. Well, so before we move on to other assets, stocks versus Bitcoin, which I'm guessing you think Bitcoin has a bigger rebound probability right now, even though they've kind of been behaving similarly.
I do. And I think the main catalyst here is the sentiment is, if you look at sentiment in the stock market, it's much more bullish. People are still saying, oh, the markets will never go down. They're still going to make another big surge versus in Bitcoin, it's, oh my goodness, is Bitcoin even going to exist in a year or two, right? That's the sentiment divide. And usually you fade those. So you go the opposite way on the sentiment. So I do think Bitcoin, and also Bitcoin's down, 50+% at this point, or about 50%, versus the stock market is down 5% off all-time highs. So there's a lot more of a correction that could occur in the stock market versus Bitcoin. Short term, I'm long Bitcoin. I'm generally short the stock market, except for software stocks. I think they're due for a bounce.
That's exactly my next point. If you take a look at my screen for just a minute here, Bitcoin is the candlestick line, and the S&P is the blue line here. So what we have is a divergence of basically historic proportions where, both of these things, asset classes, typically have in the past moved together, but ever since late September, early October, they've been diverging. Like you said, Bitcoin's down about 50%. Stocks are still near their all-time highs. At least the overall index. I'm not talking about individual stocks, which are down a lot.
Yep.
But we have here this divergence. And before we get into any further analysis, when you look at two things, it doesn't have to be Bitcoin versus stocks, but whenever you get two asset classes that have historically moved together and they start diverging, how do you make the assessment which is going to move first? Do we have a situation where the stock market moves down to catch up to Bitcoin downwards, or do we have a situation where Bitcoin moves up to close that gap, right?
So
I
I
mean,
think
you've given this. Go ahead.
Yeah, I was going to say, so what you're showing here is what we call in the business crocodile jaws, which is the jaws that are opening, and eventually they slam shut with both pieces of the puzzle coming together. And so you'd expect in this scenario is eventually them to rejoin, but probably somewhere in the middle to combine. So the stock market would fall, Bitcoin would bounce, they would reignite together at some point in the future, and then we would get a kind of traveling in the same direction going forward.
As a technician, how do you evaluate which will move first and which will move down versus up? Just walk us through your, decision-making process here.
Yeah, so for me at least, it's looking at again some of these technical signals that we've seen, right? We've seen the sentiment factors, the divergence is starting to show up, the bull flag on Bitcoin. So I would expect over the next couple of weeks, the stock market starts to come in, and then again, like I said, in the next month, I'm expecting it could even be sooner than that, some resolution with this bill, which will be the trigger for a rebound in crypto in the near term, and so that'll drive crypto up. The stock market is falling into it. They'll join up again, and then from that point on, I would expect them generally to move in the same direction.
Are you long gold at this point? Can we pull up a gold chart? It's
Yeah,
we're
absolutely.
looking at this environment where gold's basically moving $200 a day upwards and downwards. It was $5,000 like Friday afternoon, and now it's 5,200.
Yeah, it's an incredible movement here. So what we are seeing here on gold is that gold compared to silver is much stronger, which makes sense. Silver still has that industrial component to it. It had a crazy run up. There's still a lot of digestion going on. Gold is slowly creeping back up here as a safe haven trade. And again, what's going on with tariffs is adding to it. What's going on with nervousness over the AI and software stocks is all adding to people saying, you know what, I'm dumping everything, but I'm going to move into gold as the safe haven asset. So gold has upside now. It broke above this 5,100 little resistance here. It has upside to about 5,400. I'm still a little bit of a skeptic that it's going to make a new all-time high in the near term, just because, again, there's still a big overbought factor to it. But ultimately, again, the chart's the chart, and you're probably headed to about 5,400 in the next days or week or so. Downside support, we can see 4,400 right here is your downside support. So if we did come crashing down at some point, that would be a level we would be watching as a technician. Now, speaking of am I long or short gold, that's the big question. I am still holding my long-term holdings in gold, obviously long. But I have nothing in the near term here. I'm not long in the near term. It's too risky for me based on where it's currently trading.
Same sentiment with silver or not?
Yes, in general, silver is the same sentiment here. So if we flip over to the silver chart, silver is actually a little bit more bearish even, but I still am holding long-term silver as I believe in the fiat currencies and the depreciation of them and the printing and the debt. I mean, everything we talk about that's going on and hasn't stalled out. Doge is long forgotten. I mean, even what is that? Going back to it must be a crypto again. But in any case, the negative here on silver is you're stuck in between this range here between 92 and 91 and 70 to 71 or $70 to 71. This is a bigger bear flag formation, which usually resolves itself to the downside. And you can see again the big drop here and all this sideways chop. And so if we do not break above 92 to 91, then be very careful. It would continue to tell us that the odds favor an eventual break below 70 to 71 on silver.
So silver and gold. I don't think you and I have talked right after the big drawdown in silver and gold on the 3rd of February or 2nd of February. When that day happened, do you remember what you were doing? Did you buy more with both hands and feet? or did you stay out because you don't catch a falling knife, so to speak?
So in all fairness, I didn't buy initially until it came down, and then I did swing trade it on the long side, no doubt about it, right? And again, the kicker here is, and I want to show you this because this is just so cool on the chart side of it. But there were signs that the top was in, right? So for those of you that may not know technical analysis, this candle right here is what's called a topping tail. It's where you get this kind of big move up and then it closes in the lower percentage of the candle. And that again is a reversal signal. So as soon as I saw that, I was like, okay, we're very near the end. And then we got this move up, but notice we never closed above that high of the topping tail to negate it. We then got this doji and then the big flush came in. But once we got in this lower range, this is the support I was looking for. I played it for a bounce, got the heck out, and then since then I'm just sitting on the sidelines minus my long-term holdings in silver.
Interesting. All right. And then usually how far does something have to rebound from its lows, as in the case with silver and gold, before you start to, get in again? Before it starts to confirm another uptrend, basically.
So I think if you can get through 92 to 91, you should retest the all-time highs. I probably would not be a buyer above there because again, there's just so much risk and the volatility in silver has gotten so crazy. So I probably wouldn't be looking to short it or go long at this point. But what I will tell you is if the bearish pattern plays out, there's an epic level to buy where I will be buying significantly, even in long-term holdings, and that would be down here at this $54 to $50 level. Not only is it a key support from over here where we had this cup and handle breakout, but if you go to your longer time frame and you drag this back, what does this bring us back to? It brings us back to the 1980 high and the 2011 high. And usually in charts, and this is so cool, is that when you have a trend line, right? So this is like 1980 high, we pulled back, we hit the 2007 high, we pulled back, then we broke out. There's this tendency for charts to want to retest that level before making their next move, and that's that $54 to $50 level. And so that's where, for me as a buyer, where I will be buying heavily, even long-term holdings likely on silver.
Okay, let's move on to the dollar now, and I want to talk about this article. I'm going to show you this Financial Times article, pretty interesting read. The haven asset status of U.S. Treasuries is eroding. It says here, this key paragraph, Donald Trump has come close to exploding one of the great myths of the investment world, namely that sovereign bonds are safe, risk-free assets. His second coming has contributed significantly towards undermining the role of U.S. Treasuries as the world's ultimate capital market hedge. Long-standing doubts about the continuing preeminence of the dollar as a reserve currency have intensified. All right, those are pretty strong allegations, I would say. But
yes.
Is that something you feel as a trader? I mean, do you generally agree with that sentiment?
I do. I think you can see it in the charts already. Again, you're looking at a scenario now where you have, when you go after allies with these hard-handed levels, right? Whether it's, even with the Greenland scenario, but especially with tariffs on Canada, Mexico, Europe and so forth, and you really ratchet it up, the friends that are buying, the people, the countries that are buying our treasuries, they start to realize that we have too much power over them. And that goes for the reserve currency of the dollar. And so there's this concerted effort to say, okay, we need to diversify away from what gives the U.S. all their power to basically put us in our place. And so they are doing this. And there's no doubt about it. We've even heard recently that we know China's been buying less and less treasuries. They even told their banks to start moving away from U.S. treasuries. We know that now sovereign nations, countries are buying less and less treasuries. I think years ago it was 40% of all treasuries were being bought by countries. Now it's about 15 to 10%. And so this is actively going on. And I think what's even more fascinating here is that we get into the charts, right? So let's jump into the dollar chart here. And this is the scary part. If we go to our weekly chart on the dollar and we flip over, there's this long-term trend line going all the way back to the financial crisis lows. And we are now hammering on it. Look at this. Look at this zone right here. And this is concerning because this is a trend that kept. Remember how great the U.S. came looking out of the financial crisis. I mean, the Fed was just idolized. All the central banks were like, we got to do what they did. But now you're at a point where if this trend breaks, we're now in a breakdown on the US dollar. Now, I don't think we're going to crash. Currencies that are the reserve currencies don't crash like that. But is it a process that is going to continue now with de-dollarization, with moving away from the US Treasury market, especially as the debt balloons and continues to balloon? Absolutely. And so I do think you're absolutely, I think that article is dead on here.
But as an investor, what do you do with that information? I mean, do you move to other treasuries from abroad, or do you look for other safe havens?
So I think again, you have to be careful here because you could say, well, I don't want to be in T-bills or something like that because of this. But then you watch the stock market drop 20% or 30%, and you're like, oh darn, I wish I was in T-bills where I only lost 3%, right? So it's what's the least hurtful asset to be in. And so I think again, longer term, if your view is 10, 20 years out, then you're still looking on pullbacks to buy gold, silver, and crypto, Bitcoin, specifically Bitcoin. But if you're near term, then to be honest, being in cash or even in T-bills where you're making a small percentage return, that may be the best outcome. I know people don't want to hear that because we're so used to, oh, well, I made 20% this year or 30% this year. But we're coming into a period that I could think looks a lot like Japan from the 80s where it topped out. And we may not see new all-time highs in the stock market for literally 20 plus years, much like the
Wow.
dot-com top.
But this isn't. We don't have to have a major crash for this to happen. It could just grind sideways for 20 years. Is that what you're saying?
Well, yeah, but I think with sideways you'll have down periods where you're down 20, 30, 40% in the stock market. But again, a
Sure.
crash specifically, that's harder to predict like a
Yeah.
1987 type event, but I do think that again, we could be down 20, 30, 40% and it may take us like I said 15, 20 plus years to get back to those all-time highs. And for a lot of people that are banking on the rise in these assets, stocks to give them retirement money, that could really be what hurts the consumer and keeps us in this longer-term bear market because again, if inflation continues to go sideways to up, but asset prices stop rising like the stock market, people are going to be in a world of hurt when it comes to retirement in 20 years.
Okay. Gareth, let's close off on something we don't talk about as much, you and I, which is long-term preservation of wealth. This is a chart that I saw pop up in my social media feed in different forms. There was an animated chart, which I thought was pretty cool. I couldn't find it, but this is a static chart. Here we go. Purchasing power of the US dollar since 1900. And so over the last 120 years, let's say you had $100. It was the comparison I saw first was if you had $1 million, but this is the same thing. You'd be left with $3.06 today
In buying power,
in
yep.
purchasing parity terms. So basically, leaving your money in the bank long term, it doesn't matter even if it's for 10 or 20 years, 5 years, just not a good idea.
Yep.
So what does one do? Let's say someone, and I understand that not everybody watching the show right now is an active trader like yourself. I think a lot of people who follow you want to know how to trade or learn how to trade, but most people just want to know how to preserve their wealth over a long period of time. How do you approach that problem, Gareth?
Yeah, and I think this is where, when you see something like this, it really has the impact. When we hear about the dollar losing value or something, it seems very arbitrary. But again, when you look at this, $100 now worth $3.06 it's just flat out scary. And this trend is going to continue. There's no ifs, ands, or buts about it. Sure, maybe it bounces along the way like any chart, but the government is showing no signs of fiscal responsibility. The U.S. deficit continues to balloon. It's the inevitable. And so what you have to do is you have to think about, all right, listen, how do I just continue to at least maintain this? And so, if you're looking long term, if you make 3% a year for 100 years, you'd at least offset that generally. So you have to think in those terms. I still think this tells you that you have to be in the metals. Again, I'm not myself on the shorter term basis, but if we get the pullbacks, then I just continue to buy the metals. And I think you have to think about what about Bitcoin? Is Bitcoin really going away, or is that just spooking behavior to get prices lower? And by the way, I think it's important to reiterate that you don't want to go all in on any of these things. Like I'm not all in on gold, I'm not all in on silver, even long term, or Bitcoin. It's diversifying amongst assets. So if one doesn't do well, at least you're not screwed essentially. And so diversification, but always thinking again, how do I maintain my purchasing power? What percentage do I need to get per year? probably
Hmm.
only 3 to 5%, which is doable. That's doable. Again, not going to retire well on that though. Obviously based on data.
But what about the notion of just buying the stock market index and holding that for a couple of decades? I understand the risks, which you just highlighted. It could not go up again for 20 years and reach new all-time highs. One theory as to why you should do that is because the stock market in itself is a collection of the best companies in basically American capitalism. These companies, by the nature of their business, will account for inflation. Their prices will go up, and if you're a good business, you should be able to maintain your margins, right? So you're basically hedging against inflation by buying ownership of a company. Does that make sense to you?
That does. I think again, especially names that are solid, like a Microsoft, which has been beaten down recently, that pays a dividend, a company that pays a dividend, especially if you can get a dividend on something that's a solid company that's 3%, let's say, maybe keeping pace with inflation. At least that gives you that payout over the course of 10, 20 years, which really will add up. If you think about, that type of payout for 20 years, it really can give you that boost. So I agree with that. I think overall, just you have to go into it. This isn't going to be a market for the next 10 or 20 years, in my opinion, that's going to be going up 10% a year anymore. And so you have to think in the terms of, well, what if the market doesn't make a new all-time high for 20 years? Then you're losing based on inflation, right? Inflation is going to continue to go up. The stock market may not. So that's where you have to look at these dividend paying stocks that even if the stock doesn't move at all for 20 years, you've at least been paid out 3% a year on a dividend.
Well, housing, real estate, inflation hedge or no?
No, not at this point. I'm very bearish on housing. People are still struggling to afford housing, and you're also coming in the next 10 to 20 years. There will be a ton of baby boomers that pass away with multiple houses. There will be a ton more that comes onto the market, and housing will likely be the same here. You'll probably see it neutral to lower in the next 10 to 20 years.
All right. And then finally, when it comes to preparing for retirement itself, there's different options you can take. How do you feel about RRSPs and contributing to RRSPs versus managing your own money?
Oh man, I mean, I think so. You have to look at fees. Obviously, fees are very important. You want to make sure that the
Hmm.
fees are low for any of this stuff, and it's also how much time can you devote, right? One of the things I do here at my own company is I focus on trading. I have a managing director that's handling the business and all the little nuances. You have to pick what your focus is. You can't be too spread too thin. I'm certainly not an expert as managing a full business. My expertise in macro and trading, so I need to focus there. And so if you're someone who does this for a living and you can devote
Yeah.
that time, then it makes sense to manage it yourself. Otherwise, I think you have to kind of look at other places that can do it better and you focus on your main career path where you can excel.
Thanks a lot, Gareth. Well, tell us about how we can learn about your work and learn how to excel from you.
Hey, thank you. So just come to Verified Investing and check it out, guys. It's all charts, no BS, meaning probabilities is what makes our decisions here. We have so much bombardment in our lives on social media, the narratives, the hype, the FOMO, the FUD, all that stuff. It's refreshing, in my opinion, to know that I'm never going to be 100% on my trades, but can I win 70% of the time or 75? Yes, I can by following the charts. That's what we try to help people learn how to do.
And we'll put the links down below, so make sure to follow Gareth there. Welcome back to the show, Gareth. It's good to see you as always. So we'll speak next time. Take care for now.
Thank you. Take care.
Thanks for watching. Don't forget to like and subscribe. Don't forget to follow Gareth in the links down below. And don't forget to use my code LIN, LIN, when you sign up to Kalshi. Link down below or scan the QR code here. New users will get $10 deposited to your account when you trade $10.